A financial plan is a forecast of future performance for a business. A financial plan will help you plan and optimize your expenses such as startup costs, fixed costs, and cost of goods. Plan and manage cash flows effectively. Estimate your income and profits. Look at the financial plan template document. Create two versions of this. Use one version to forecast the spend and revenues for 1 year, and the second version to record the actuals, the month-by-month spend and income during the year. Note cells of 3 colors: orange, yellow, and gray. Orange cells require you to input data. Yellow cells allow you to modify the data in them. And the gray cells are formula driven. So don't enter any data in the gray cells. As an entrepreneur, you will need to be familiar with these terms and concepts like startup costs, operation costs, cash flow, break-even analysis, and balance sheet. Let's begin with startup costs. Startup costs are the initial expenses you will incur when setting up your business. Consider these questions. Do you need to register your company? Do you need to buy any equipment for your business? All these together make your startup costs. Input these details in the template. Now input your startup capital. You need to know if your starting capital will cover all your startup costs. If not, you need to find funds to cover your startup costs. By now, you have completed your sales forecasting. You will use the figures from your sales forecast document to fill up the second tab of the template. You need to enter the figures from your cash sales and collections from the accounts receivable separately. Next, you need to find out what will it cost to produce the products or service that you forecasted. Imagine you are setting up a sandwich shop. You need to estimate the cost of raw materials such as bread, vegetables, meat, and cheese. Next, estimate the cost of packaging each of these sandwiches. Do you pay any rent for the sandwich shop? All these make up your cost of goods or COGS. Apart from your startup expenses, your business will have other expenses called operation expenses. Do you need to hire a team to make the number of sandwiches you have targeted for each month? Are you going to create posters to advertise your sandwiches? Operation expenses are your day-to-day costs for running your business. The template will calculate your net and gross profits on a month-to-month basis. During the day-to-day operations of your venture, cash comes in when customers pay for your sandwiches in the sandwich business. Then some amount of the cash goes out when you pay vendors. This is cash flow. Now your business may be a profitable one, but if the cash you pay out in a month is more than what you receive from your customers, you have a cash flow problem. You need to make sure that the cash you receive is more than what you need to pay your bills every month. Do you know how much you need to sell in the first 12 months to cover your costs and break even? This is your break-even analysis. In the financial template, enter the average sales price of 1 unit of your product or service and your average cost per unit. You will get the number of sales you need to make to break even. Now let us talk about the balance sheet. The balance sheet is not something you fill up now. At the end of the first 12 months, forecast your balance sheet position. Your balance sheet tells you and your stakeholders 3 things. What are your assets? What are your liabilities? and what is your shareholders' equity. Assets are the resources or things that your company owns. Liabilities are your debts or the amount that your company owes to its creditors. Shareholder equity is the difference between your total assets and total liabilities. The balance sheet is the financial template that draws on the figures you have entered in your profit and loss forecast. So go ahead and fill up your financial plan. This is a crucial step in estimating the viability of your venture.